Well, there had been a rumour around the market yesterday that Chinese GDP would be 7%, not the 7.7% that the economic boffins were still predicting. So when the figure of 7.6% hit the screens, there was a sudden relief rally worth nearly 40 points, which then faded as the day wore on. Here are the details of the data. Retail sales and industrial production both weakened slightly, and GDP growth is almost exactly what the latest 5-year plan in China had forecast. Now, bear in mind that it's just 2 weeks since the end of the quarter, and it takes the Australian statisticians 2 months to produce this data. But I guess it's easier when you start with the answer. Here's a chart of Chinese GDP growth, and you'd have to say that those 10% plus numbers are a thing of the past. Here's where the Australian share market ended up, 1/3 of 1% higher. There were no real standout performances one way or the other. The financials did best, led by AMP. Retailers all rose, but resources stocks were mixed. European and American markets posted quite sizable falls last night, especially the smaller European ones, where bond yields are rising again because investors are worried again about whether those governments will actually make it. And the Australian dollar is the same as it was last night. There was a bit of a twitch at midday when the Chinese data came out, but not as much as the one on the share market. And finally, a chart that throws a bit more light on Australia's weak consumption numbers. As we know, the high dollar has meant that more people are travelling from this country than to it. There are now 8 million short-term departures per year versus 6 million short-term arrivals, a deficit of 2 million out of a population of 22. Now, up to 2005, net tourism was adding 1 million. As the AIG says, consumers are not cautious, they're just somewhere else. And that's finance.